Thanks, Deanne. Thanks to my fellow panelists, and thanks to all the participants for making time and joining us in the middle of the day for what should be hopefully a helpful session for you to understand what are the issues that fund managers are grappling with. Not just for the past 2 to 3 months over the COVID-related environment that has been on, but also generally what are the more secular trends that they see as emerging over the last couple of years. Uh, we are going to consider COVID in a lot of the analysis that will be discussed today. But again, looking at COVID as an aberration or looking at COVID as something that would leave a very lasting impression on short to medium term, how are the fund managers sort of looking at it? Now, for the participants today, we have a very rich range of fund managers on the panel. We have Kalpesh Jain from Multiples, one of the foremost private equity houses in India, Multiples. We have Jinesh from Omnivore Capital, who represents a more conscious capital, while they generate the usual return-seeking LPs, something which is matched with social conscious at the underpinning. We also have Praveen Dwarkanath, who is an emerging hedge fund manager. Praveen, like Diane introduced, manages White Space Alpha, and at the same time, this is something where they provide sort of option strategies where these are market neutral in nature. So we will hear from the three separate fund managers what the different issues mean for their respective asset classes, their respective funds, and also the respective LP bases whom they support. Now, is this business as usual or is it business as unusual? That is something that we hope to sort of learn from them in our discussions today. So I think I'll start first with Kalpesh. Kalpesh, welcome.
Thank you for having me here.
Thank you, Kalpesh. Kalpesh, so I think the first question to you is that you are sitting hopefully on a very meaningful first close that we could achieve for your Series 3 fund. The question for you is in two parts. Number one, what was your experience in the entire fundraising mode? The close obviously was announced prior to the COVID sort of really hitting global markets in a big way. But obviously, there were certain secular trends which impacted our fundraising. It may have taken a little more than what we envisaged, or we saw a lot of enthusiasm from the LPs. Happy to hear your thoughts. And also, sandwiched with that is the issue that what has been your interactions with the LPs? How have they seen? How have they sort of seen the period after your first close and now? What is their reaction to what's happening globally?
So I would say the first close has taken longer in terms of a trend. What I've been seeing, primarily because the investors globally are looking India cautiously and want to be very selectively invest in specific funds and specific team what they are looking for. Going back to, yes, there is a you know, every fund's experience past trends what they have in terms of their results in past, which is there, but I think what they also future wise looking is what is the potential in India, and that has been a very critical thing which every investor has been looking at, which has delayed the uh, process of fundraising. But we have been fortunate that we could have a fund first close of a good 600 million there, and sitting with a dry powder there, as which makes it more difficult now with the current situation, that how and when, both question how and when and which sector, and what is the timing of investment. But interestingly, the investors after signing up have been very supportive. I would say in terms of evaluating various companies, uh, what is a kind of co-investment, the opportunities they also want to evaluate in this situation. That's also been happening. Uh, I think what I see is that in next the whole investment process in next 4 to 5 months is going to slow down quite a bit. Companies, funds may actually evaluate a lot of investment opportunities, but actual investment only may happen in 6 months to 9 months time. That's what is a trend I'm seeing. Secondly, on the fund, our earlier fund investors have been very uh, closely watching the situation with the portfolio companies. And the trend, what is coming out is that they have been very supportive or wanting to understand the fund liquidity issues with the portfolio companies and figure out a way how these companies can be funded in different forms or different ways. So, which is what is the trend coming from the large LPs.
Got it. Got it. No, I think I'll take the cue from there. So you did mention that your LPs are conscious of what's happening with your portfolio and trying to gauge, obviously through you as their gatekeepers, that what are the liquidity needs in the portfolio company level. But have you seen, and especially because you have a bouquet of LPs which are global asset allocators, you have the pension plans, you have the sovereigns, and so on and so forth. So, have you seen them bringing something additional to the table from an experience perspective? That okay, we have similarly allocated in other markets, other geographies, other funds, and we have also seen what perhaps maybe seem to be working with some of the portfolio companies. Has that conversation happened so far, or do you see that everyone's suffering the brunt at the same time, and accordingly, it's a lesson learned simultaneously across all markets? What has your experience with your LPs been so far?
So, I think the first level of experience came from the set of Hong Kong investors who have their base there in Asia Pacific. And what has come out is that what investors have been saying is that you need to be in touch with your portfolio companies virtually every week. What is the situation? How the situation has been emerging? What are the areas you should be looking at beyond liquidity? Is the supply chain issue now or it will be permanent? How are you reacting with your stakeholders? How are you taking care of people? Funds which are very ESG conscious, their sort of a mandate, I would say, is that there should not be any job cut. You could maybe evaluate a salary rationalization, but not definitely a job cut. So it's a varied kind of experience coming from across different set of investors, which is also been useful when we are interacting with our shareholders, and they are also finding it very useful. In fact, experience about raising funds for this portfolio companies in different way. Again, ideas are being given to us by the investors how it can be done, what sectors, which companies have raised money in different ways in other countries. So this has been very, very useful and handy while we having this similar discussions with our portfolio companies.
Great. And I think, and I know you have to rush to a IC meeting after this. A quick question to you, like, how are you looking at your rest of the road towards fundraise? Do you see LPs asking any sticking issues, any new LPs, new issues coming up? Are you looking at any pressure on the equalization that it should no longer be a straight line calculation of some preferred return based formula, but look at us as a rescue capital? Don't look at us as a subsequent close LP, but a rescue capital, and accordingly give us a discount or let us come at par. Are you seeing any discussions in that direction?
Frankly, so far, not much discussion has happened since April first week. I think if any such discussion comes up, it will be not only in early June. But I don't see that ideally should not be an issue because with having large investors already in the fund, I don't see other investors coming heavily on commercial aspects of the fee or other things. I don't anticipate, but I really don't know. I would say only time in June will tell us that what really can happen there.
Sure, sure. No, thank you. I think here immediately, if I can, Jinesh, perhaps cue you in. Omnivore obviously is defined as a financial first impact investor, though. And you obviously do look to deliver market rate venture type return, but at the same time have a meaningful, measurable impact, basis which LPs have sort of committed to the fund. Accordingly, what is the role you see yourself as a GP playing in this level? Are you like a gatekeeper between the LPs' own wishes for the portfolio, or do you see your portfolio to be very uniquely placed insofar as COVID is concerned? Obviously, you look at agri-tech and food systems and so on and so forth. So how do you see this COVID impact, and what do you think is the LP reaction to this situation right now?
Sure, Richie. I mean, as you rightly mentioned, that we are a sector fund focused on agri sector, and we are financial first impact fund. Uh, we've been fortunate enough right now that most of the portfolio companies are either got recently funded, they fund, and no one has no investor has walked away from that. What is really worked out is that in this crisis, where every other sector seems to be having some kind of an issue, for us,
Jinesh, so sorry to interrupt. I think your voice is slightly feeble. Can you increase the volume if you don't mind?
yeah, sure, yeah, this is better.
Yeah, thank you.
Within the portfolio, right, Richie, what we have seen is that most of the portfolio companies had initial hiccup during the lockdown was initiated, right? But after that, since it's agriculture is defined in the essential sector, we've been fortunate not to face any brunt in most of the portfolio companies. I mean, out of the 20 odd investments we have, right, I mean, 18 of the portfolio companies are working at a normal business, right? I mean, they're working at the full capacity. So that's working well, right? But uh, we've been very cognizant of the fact that this kind of event is something which was not anticipated. Cash flows have gone for toss in terms of collection cycles have gone completely haywire in terms of vendors are not really prepared for this kind of thing. So we've been trying to work with all our portfolio companies to figure out what is the best way we can do, right? And fortunately for us, I mean, most of the investors are DFIs or socially conscious investors. They've been giving more than helping hand to us and also to all our portfolio companies if they could help us out, right? They've been guiding us in terms of toolkits, in terms of what are the ways and means we can work out. Some guys have come out with a technical assistance support for portfolio companies, helping saying that, guys, this is something which is not of any manageable scale. If everyone can pull their resources together, can we figure out something which could be having least negative impact for the portfolio company? And most important, our stakeholders, the farmers, right? Farmers,
Right.
I mean, the fund focus is to help the small farmers, right? So, is there everything we are doing within our means that we are helping the farmers not to go down right now in this crisis? Uh, because whether we like it or not, the poorer people are more at risk in this kind of COVID crisis. And our LPs have been very, very supportive about the same. Someone are going out of the way saying that they don't mind looking at alternate means of financing if there's a need. But till now, things are not gone out of control. Things are manageable, but if things go out of control, maybe we'll have to go back to LPs and seek the additional support.
Sure. This is quite helpful. And do you see any of the LPs sort of coming back and saying that can they look at co-investment opportunities, or have they thought of any liquidity windows for the portfolio, or are these questions coming up?
Uh, I mean, one of the investors already had done has done a co-investment in one of our portfolio companies, but that was pre-planned, right? At this point of time, there is not major crisis in terms of cash flows for the portfolio company. We seem to be in a manageable position, so that question has not arose. But LPs have come back to us and saying, guys, if you need some ways of changing the instruments of investments, whether it's a co-investment or it's a terms of pseudo equity or some kind of a debt, they would be happy to have a look at that. But we don't have an event up till now.
Right, right. No, so I think, and obviously this is to share experience with the wider participants which are out there. In a recent case, we had seen a situation where some LPs had requested a GP if they could do a top up on the structure. Now, this particular fund was already beyond its final closing date. Thankfully, the structure had a master feeder arrangement where the LPs who wanted to top up were coming through feeder. So in that particular case, we could design a situation where a new class of shares could be issued at the feeder level, which will have its independent economics, could directly invest in the portfolio company. And at the same time, you could ring fence the assets and liabilities of the new class through contractual mechanisms. And because these were also by and large DFIs, there was mutual understanding that, okay, in case any liability comes from the new series which is being created, then it will be pocketed by the new bunch of LPs only. And the GP was accordingly, able to find a solution without creating a new structure or renegotiating the LPGP sort of documents, and work within the current framework and how they could sort of quickly come up with the capital for the portfolio company. But again, do that and many more as we go along to discuss.
We had one situation where one of the DFIs have come back and said, guys, if all our portfolio companies, any of our portfolio company needs some kind of additional grant or technical assistance, they have extended the supported, and they already have issued some TA assistance to a couple of them.
Great. So I think that's a point that every participant should note, that the moment you have accessed capital from Omnivore, you have sort of come within the group of the DFI protection. And if you have any situation, you can always go to Jinesh, and he has a line of capital for already earmarked for you. So yeah, that makes Omnivore the preferred GP in the room. So I think with that, I'll take the discussion to Praveen. Praveen, as an emerging hedge fund manager, obviously yours is a very different asset class compared to private equity or what could otherwise be labeled as conscious capital. But and obviously you're more uniquely placed because you're constantly fundraising. You have an open-ended fund architecture that you look at. So what is your sense on the investor appetite for such products, and how do you sort of create an edge for yourself in the marketplace?
Richie, thank you for the kind introduction that your colleague had given to me and for the question I'm having here. I want to tell you, Richie, that when I finished my MBA, it was in the year 2009. Okay, this was right after Lehman Brothers had taken the complete toss. So this kind of feels back home. Okay, so the crisis is where I've always been used to being in this kind of an environment. So the mental attitude is kind of the same. Getting back to your question on what exactly do you see as investor appetite and what you do, I'll probably take a minute to let you know what we do, and then I'll tell you how investor appetite works. See, what we've done is basically developed a set of market neutral strategies. So we don't worry about whether the market is going up or down. The investor can decide whether he wants to invest in equity or the investor picks the asset class. We leverage the asset class and we give him additional alpha returns on top. That's what we do. So I mean, we've done really well through the entire market crisis, and it's been a way in which we could kind of prove the proof in the pudding. So investors who already invested in us have been very happy. There are a lot of new investors making a beeline saying, you know what, if I want to take a conservative bet, I will probably put it into an FD or into government securities or liquid funds. You guys can leverage it and give me the kind of returns that equity is offering. Now, having looked at that, we also look at this as one major opportunity, because one of the things the COVID crisis has done is it sent the interest rates crashing down all over the world. Right? So we had the Fed recently taking the interest rates close to zero. This gives a very unique opportunity to India, where taking into account hedging costs, if we're able to deliver a meaningful return to investors around the world, there is a lot of inflow that we are expecting from developed economies. So in a way, we look at this as an opportunity, and that is the way we choose to.
Great. But any specific questions that you are countering right now, like is your product being compared to anything else which has easier liquidity norms? Like your structure would have some amount of fee and economics baked into it. So if your product is being compared by somebody else, how do you sort of demonstrate that why your product is superior and obviously merits the larger ticket size? Unlike a PMS product which is at 50 lakhs today, or a mutual fund which is obviously all out there. Why would somebody look at a AIF sort of a constricted model? What is the extra alpha that the LP is sort of accessing by partnering with you in your platform? So how do you sort of defend that?
Yeah, I think I have to thank COVID in a way, because what it does is it throws your classic stock pickers out of the window. So every person who's thought of himself as an equity analyst and decided to pick a basket of 10, 20 stocks, every assumption that he's made has been incorrect. Right? So there's currently a beeline of people sitting on the footpath who've been doing that. So we don't worry about balance sheets and P&Ls and management structures. We believe in some ultimate truths which are mathematics. Right? So everything that we've done has been based on hardcore math, and the math is going nowhere. So given that has been the situation, we've been able to beat the market on a very consistent basis. We don't just beat the market on an annual basis, we beat it month on month. And all our option positions we take expire at the end of the month. So our investors get a beautiful monthly statement saying, you know what, this is what the market did this month, whether you pick debt or equity. And this is the additional part that we've done for you. We are not planning to take our fee down a single rupee, Richie. We are expensive, and we are proud of doing that, because the investor doesn't worry about how much he pays you. What the investor worries about is how much he makes for himself. So given that we've been beating the market on a very consistent basis, we've been able to generate an alpha of 12 to 15% over the market. And we've been doing this month on month. So people know that there's a method to the madness. We've done this through the US-China trade war. We've done it through the elections, through the budget, and now through COVID, right? So the math works, and we've run it through a very, very rigorous set of quality checks. So we are not looking at management fee pressure per se. The biggest pressure we actually face is in trying to answer your question. And we struggled with this before COVID. But COVID has helped us because now we can go ahead and tell people that, anybody who's picked stocks for you in the past, let me know how your portfolio is doing, right? So it's actually a very simple answer for us now, because we can say, you know what, whoever you pick, any fund which has been long only, whether it's been mutual fund or a PMS structure, they're also not allowed to take leverage. So AIF is allowed to take leverage while a mutual fund and a PMS is not. So when the market is falling and we are able to guess that with math, we can take advantage of what is going on. So that is one way in which the current crisis actually helps us.
Thank you, Praveen. I think with that, we will now jump to the next segment of our discussions, which was on fund terms. And when we talk about fund terms, obviously, I think one point that we would definitely like to note is that the industry in India has definitely reached some level of maturity, where we no longer see negotiations on what are core economic terms or the basic terms, but more narrower channels of, what is the carry allocation program, what are the no-fault termination events, what are the consequences of those, what would happen if there are significant write-downs in the portfolio, how do you look at your management fee, and so on and so forth. So obviously negotiating the LPGP documents are getting that much more nuanced, and the LPs are also getting globalized. So no longer are we looking at family offices or the Asia Pac regional allocators only investing into India funds, but we are now increasingly looking at sovereign wealth funds. We're looking at pension plans, university endowments, who invest on a global basis, and accordingly, the fund terms being offered by managers in India are being benchmarked against what would have been offered by a GP, let's say in California. So increasingly, you're looking at a lot of the recently raised funds, especially the 2013-14 vintage and onwards, where a lot of the terms on offer are global in nature, which obviously could be a little painful in the first close, but as and when the GPs are raising money in the subsequent closes, the path becomes that much more easier, because there is a lot of common understanding between the LPs who understand where each of the different buckets of LPs are coming from. With that, I think I also have with me on the panel my colleague Nandini on the call. There were a couple of points I thought I'd discuss with you. The first one was that what's the impact of all that is happening in respect of the length of fundraising? Obviously, this is not an issue for Praveen. Praveen is perpetually fundraising, and now we believe COVID has made him happier still. But more from a VC private equity perspective, are you seeing any lengthening of the fundraise cycle? What was usually 12 months to begin with? Has it increased? What else are you sort of looking at right now?
Sure, thanks for that, Richie. So there obviously we need to look at it from the perspective of different stages of fundraising. Those who are done with their final close do not need to worry about this. But those who are still in the fundraising mode, or even worse, those who had just started up, I think they are rethinking timelines for sure. The travel restrictions across the globe have impacted marketing or raising of funds in this situation. The operational due diligence that LPs carry out, especially for first-time managers, where they want to look at the infrastructure of the manager's team, look at how on-field the management services will be provided. All of that is getting impacted because of these travel restrictions. So I think one is for GPs to be able to extend their current raising period. But I think more importantly, GPs are going back to their fund documents and changing the overall fund period altogether to say 24 months plus 1+1 as opposed to a 12 plus 1+1. Because we really do not know the end of this situation and how long will it take for things to gain normalcy again.
Right. No, thanks for the feedback, Nandini. I think to the participants at this stage, let me make a mention We have unfortunately assembled in front of you GPs who have done very well recently. Kalpesh indicated how his Series 3 fund has already raised commitments of 600 million plus and on its path to hopefully come very close to the $1 billion mark on the fund 3. Jinesh obviously has achieved his final closing of his second fund. And even if some portfolio companies are facing any strife, he has very friendly and helpful LPs who are willing to sort of come in for their extra chunk. And Praveen, you just heard, is very happy that COVID is there. Unfortunately, there are other buckets of GPs also. We as fund councils obviously are privileged to have these sponsors as our clients. But on the other side of the roster, we do have fund managers who obviously have not achieved a meaningful first close or are looking at rolling closings. Like instead of having meaningful LP sort of come in together for some appreciable amount of new corpus, we see GPs now trying to achieve rolling closings, which means that every time an LP sort of signs up the documents, we declare a subsequent close so that they can participate. This obviously creates different kinds of challenges. The first one is that if the fund has already made some investments, then technically the first close investor would expect that a subsequent close investor would sort of contribute towards the equalization mechanism. This, as the participants may be aware of, means that if an LP has already contributed a larger chunk, given that they were the only LPs at the time of first close, as soon as a subsequent close LP joins, they would get diluted on a pro rata basis. Now, what is happening is that what was to begin with a simple, straightforward math formula, any incoming LP would know that in how many days after first close they are sort of joining in, and what would be the equalization premium that would be attached to their participation. What is happening is that a lot more LPs are expecting that they be perceived as a rescue financier more than a subsequent close investor. And accordingly, instead of coming in at a mathematically derived up sort of a premium, they're looking at a discount that can we look at a NAV as a basis and figure out what is the true value of the current portfolio. Now here, I think we've seen GPs and successfully so defend with the argument that COVID and COVID-related impact is somewhat short to medium term in nature. When you are looking at a VCP type of a play, it's a 10 to 12 to 14 year sort of a illiquid commitment that has been signed up for. And accordingly, these events are not in a nature where they should the first close LP should forego their premium, which is attached to them coming close. So and the best part is we have seen subsequent LPs dropping such asks because there is merit, and obviously in the time when there is a close after their participation, they may be facing the same challenges. The second issue we have been seeing with these situations is on benchmark commitments. Typically, you would have institutional LPs who would say that, okay, our participation in the fund is going to be capped at 20% or 25%, or the fund should not make any single investment which is more than 15% of its corpus. Then the challenge comes that if the fund is not able to achieve the intended ballpark of their intended final close, then what happens to the investments that were made before the final close was achieved? In that case, should the GP sort of liquidate the extra investment? Should the GP go to the LPAC, the advisory board of LPs, and figure out what would be the best way forward? Because to create liquidity on the excess may be difficult. Or should it be a day one sort of a situation that at any point in time, whatever is the corpus of the fund cannot, let's say, exceed the 15% mark on the benchmark commitment. This, of course, always is subject to the AIF regulations, which say that no category 1 or 2 AIF can go beyond 25% of their investable funds in any single allocation. The other challenge we have seen is on recycling of cash flows. What's also going on, and it's a very interesting observation that is coming in, that for funds which have some sort of portfolio level liquidity sort of available out there, instead of making distributions to the LP, they are seeing that how can they sort of churn that capital and reinvest that into either existing portfolio or into a new portfolio. This is sort of to make sure that the LPs don't face a new drawdown notice. Having said that, obviously the fund economics will have to be taken into account. That does it stop the meter on IRR on the original cash flow that was made by the LP? Does the churn of capital reduce the unfunded commitment of the investor? These are the most stickier points that can sort of come up. in these situations. But having said that, this is a very real solution out there on the table, and we see quite a few GPs sort of inquiring in case they have some amount of cash flow visible from a portfolio company. The question to actually both Jinesh and Praveen now would be around the management fees. Now, obviously, Jinesh, from your perspective, management fee, given that this is an illiquid fund, have you seen the 220 model come under pressure, or do you see this coming under pressure when you do your subsequent closes, or do you feel that the LPs have been quite understanding on the expense structure of the manager? Obviously, you have to keep the lights switched on, you have a team to sort of maintain, and so on and so forth, and the compliances are not getting easier. We as lawyers can definitely vouch for that. So do you see the 220 coming under any pressure in your case?
I think it depends on the LP class. I mean, I think most of the institutional LPs or global LPs who've been doing this business for quite some time, they understand that the 220 has come to a conclusion based on the expense of running a fund, the cost of managing a portfolio, and there is no way you could reduce that amount beyond a point, right? You have some buffer here and there, but you need to travel, you need to pay salaries, you need to get people going, you need to do diligences, and there is a team required for the same, right? So you cannot cut down the cost beyond that. Yes, some HNIs might be asking, saying, okay, my NAV has gone down. Are you going to look to reduce the fee expense? And unfortunately, you tell them, guys, this is not the way you work, right? You're coming into a fund which is 10-year, 12-year horizon. You cannot be looking as one-off event as a, because these are aberrations. And you're not going to get COVID kind of lockdowns every year, right? And I seriously hope so, right? So people, we have to tell to LPs, and they are understanding. I mean, yes, they would tend to, HNIs would tend to request for some kind of a waiver or deferment, but we unfortunately we don't have much room to that, right? And what we are seeing, GPs which have been able to deliver the performance in the previous funds, I mean, or have been doing good in the existing funds, they've been able to get away from this kind of discussions, right? I mean, yes, but some LPs, especially Indian LPs, are asking this.
Got it. And Praveen, from your perspective, given the liquidity in your portfolio, where investors obviously, sort of retain the right to redeem their position after the lock-in sort of periods are over, do you see the nature of the asset class impacting the management fees in your case, or do you see somewhat convergence of views on what the management fee should be?
I think we are very close to the 220 model ourselves. Okay? Sometimes we exceed the 220 model rather than 20. I think the question of fees always comes in as a function of performance. Okay, so when your investors are happy with your performance and frankly they're grateful for what they're getting right now, I think we have not faced any pressure when it comes to fees per se. Okay? But having said that, I mean, there is a real risk that is going around in the industry where a lot of long-only portfolios are taken everything. And a lot of people in the industry have come under pressure. 220 has become 110, 105. There's been a lot of pressure which has been going on. So while you rightly pointed out, I think you picked a set of panelists today who have not been hit too badly with this. But then I'm also sure you want the industry perspective. The 220 has definitely come under pressure. Right now, I think it's much closer to 1 in terms of management fee and maybe 10% in terms of success fee. Looking at the watermark actually being as high as that, as opposed to fixed.
Right. Thank you. I think we obviously need to broad base the GPs we are accessing. I think all our GPs seem to be thriving in the current environment, and we don't get to hear the pain of all this in this conversation. So I think now I'll again look at Nandini. A question for you that now obviously we are looking at situations where the portfolio companies may need access to liquidity. Do you see the fund documents enabled for that? Let's say the fund is after its final close. Do you see the fund documents enabled for that, or have you seen some new structures being explored so that they could be top up by some of the investors, and that could be used for making investments in the portfolio?
Sure. So yes, there is a sort of change with respect to investment allocation of funds that they started with and that they are now considering given the situation. But obviously, you can't digress dramatically from the investment thesis with which you began the fund. So all you can do to help your portfolio companies at this stage and well within the framework of your governing documents is actually to figure out the instruments which you can look at differently than you were looking at so far. So maybe like from a classic equity, you would move to a quasi debt sort of a structure to be able to satisfy both your portfolio end of requirements and your LPs who do not want you to venture far from where you began. So that's how GPs are going back to fund documents and trying to play around their investment allocations, not just with respect to instruments, actually also with respect to subsectors, to the extent possible without disturbing the core of their investment thesis too much.
So I think with that, I would also like to sort of bring up the topic around the structures which are being explored. Now, obviously, a lot of the participants may feel that in today's environment, obviously not talking about the GPs whom we have on the panel, but there has been a real struggle in getting LPs to agree to commit to a fund. So what are the structures we are exploring in that situation? So I think here what we have seen is two separate approaches. Um, uh, the first one is how can we redesign the entire thesis of the platform. So just to give you an example, unlike an LP which is committing on a blind pool basis over a 12-year term and so on and so forth, GPs are now today exploring structures where could they give a deal by deal participation or access to investors. Now, obviously, the AIF regulations are not accommodative of that. AIF regulations require a good portfolio alignment between the LPs, so such that all investors participate in all deals. But in jurisdictions like Singapore with its variable capital company, Mauritius with its protected cell company structure, similarly with Cayman and Luxembourg, it is possible to have liability ring-fence structures to be created such that you can have investors come in segregated portfolios at the overseas level. That overseas entity could either directly invest in India, or it could come in as a contributor to an AIF and let the AIF be the ultimate investor. Now, this obviously is very meaningful from a real estate infrastructure perspective, where a more one-on-one mapping between the LP appetite for a particular deal sort of supersedes the whole fund model that is usually otherwise prevalent. It is also the case when there are certain LPs who want to co-invest with the fund. But at the same time, the deal originally by the fund was structured through an AIF, where the LP obviously cannot look at co-investments coming in. So in those cases also where they want to take advantage of the AIF as a vehicle, perhaps they could consider coming in through a feeder vehicle, and the feeder in turn could, being the common contributor to the AIF, could then enable the co-investment route. So again, those are the structures which are being looked at, and here obviously we have to definitely make sure that we mention the gift city based models that are evolving. No discussion on a structure today can really be meaningfully be done unless we have mentioned all the three routes: overseas routes, onshore routes, and midshore routes. Overseas routes like Mauritius, Singapore have been tried and tested. Onshore AIFs have been going on since close to a decade now. And obviously, the Cat 3 AIF regime has its own pain. We can discuss at length on the opacity around the tax structure, the lack of ability to make concentrated portfolios. I think to all the participants on the call, just to make a small point, that Cat 3 AIFs are capped at 10% of their corpus when looking at any single deal, which really makes concentrated portfolios a difficult bet to sort of carry across. Or maybe the asset class could be commodity derivatives, where not each of the commodity derivatives have the liquidity or the bandwidth to absorb an AIF allocation, because we are then looking at 10 different opportunities. So a good solution between offshore and onshore was a possible mid-shore solution coming out of Gift City. Now, Gift City, I think, as most of the participants may be aware, is a IFSC being set up in Gandhinagar, which is where we see a new regulator being sort of earmarked, which has a combined power of both SEBI and RBI rolled into one. So we are very hopeful that once the members of this committee are sort of identified, applications would be made to this unified regulator, and the unified regulator should hopefully have an appetite to allow more unique offerings, more unique products, which they may not be comfortable offering at the onshore India level. Perhaps something like a credit fund, where the AIF can literally buy loan portfolios or give loans, which is literally a combination of a pooling vehicle like an AIF and an NBFC, which is regulated by RBI. This should be possible or could be possible because the unified regulator, like I said, is a combination of both RBI and SEBI. They could perhaps also look at GIFT City as a regulatory sandbox, where they should perhaps allow Cat 3 AIFs, a slightly higher concentration levels in the portfolio, doing away with the 10% mark, which was something which comes from a more mutual fund type environment, where obviously the need to diversify is very, very crucial. Whereas in case of AIFs, when we are talking about sophisticated LP bases, where the minimum ticket size is 1 CR and so on and so forth, in those cases, perhaps a more concentrated portfolio should be allowed, because here the dialogue between the LP GP is as good as a dialogue between the fund manager and the regulator. There cannot be a better regulator than the investor, right? So in some senses, maybe the GIFT City structure could emerge. With that, I think I will now ask my different panelists, starting with you, Jinesh. Now, obviously, when we talk about the different shapes of recoveries, a U-shaped recovery, a V-shaped recovery, or a Nike swoosh, I won't even call it a J-curve anymore. Which do you think? And obviously, L is not part of the options. So tell me, U, V, or a Nike swoosh. What do you think?
I mean, if I would take a choice between three, I think I would try to get a new figure. But I mean, if I would take a choice between three of them, either three of them, Nike should be the option I would take in. But what I see, Richie, is that we believe that India is going to open up sooner than later in terms of the lockdown restrictions going down. But COVID as a crisis is not going up in a hurry, right? So we will have issues of supply chain disruptions happening in various parts of country, because if there is a surge in COVID cases in a particular area where there is a portfolio or there is a supply chain is a bottleneck, you could see a disruptions happening there, right? And as a country, we think there will be some kind of a VV recovery where you will see a significant improvement happening in next couple of quarters. But there will be few quarters where the growth would go down, the few will come up. We're not going to. I think a new shape might be emerging. I mean, that might be my take.
Right. I didn't throw W also as an option, as you would see.
C will be a better option, right? You will
okay. Okay. I think moving to you, Praveen. Obviously, I think let me add something more to the question for you. More than the options, the question for you is that in a COVID type environment, there is an immediate reaction on an overnight basis or a hourly basis or a second by second basis. There's an immediate feedback in the market prices of the assets, especially in the liquid side. Whereas there is obviously a lag between the public markets and the private markets, insofar as the COVID's impact was concerned. Now, obviously, I'm not even saying that there is no question of portfolio revaluation for private equity VC type situations. But in your case, given that how it has a devastating impact on the NAVs, not exactly your strategy, but those which are like just long only funds or public equities fund without a meaningful hedge component. So for you, from your vantage point, what do you think is the implication of all this? And obviously, the finisher, what is the shape of the recovery that you think is the most feasible one?
Richie, I mean, if you look at the preamble to our constitution, it starts off with India being a socialist country, right? So I don't have too much hopes on a swoosh Nike thing going there. I would love to be wrong, but I don't see that happening, because our politicians are falling all over themselves to see who is the best at declaring the best lockdown of the lot. So I sit in a city called Hyderabad, where my chief minister wants to do this one-upmanship over Modi, and he's banned Zomato and Swiggy for God knows what. Okay, so his very press conference was saying, "Why do you guys eat pizza? I mean, go eat like dal rice. That's all you guys do." That was literally the CM press conference. So given that the politicians are saying this, the politicians are not saying this because they just had a couple of pegs and came down to the press conference. That's not how it works. The real answer is that the public is enjoying the lockdown. Okay, so they feel safe and secure at home. And what the politicians are saying is a reflection of public wishes. Okay? And if you're staying in a large gated community, you will be seeing the amount of mails that will be going on in your entire internal apartment groups. You will be seeing that the fear is reducing, but the fear is still there. Okay, so no politician worth his salt is going to pull the lockdown in a hurry, because that means that he will not be able to justify why he put the lockdown in the first place. Right? So I see this lockdown situation continuing for some more time. So it's not going to be as simple as before. I think when we are looking at this entire COVID situation, how is this going to go? U. As much as I like the Nike, I would have to bet on the U. Okay, I don't see this being a V-shaped recovery, mainly because I don't think that what has happened in the last 2 months can be wished away in a hurry. Okay, now you would have a lot of. I personally know of a lot of startups that have shut shop. I know people who've taken a pay cut. Okay, so what you did is you constrained supply. Because you constrained supply, demand has now been reduced. Okay, bringing up demand is easier said than done. We are not the US where we can claim QE infinity and pump trillions of dollars into the market. We don't have it. We've been throwing away a good amount of money doing our usual populist schemes by themselves. So I don't see a way where we can do a V-shaped economy. We don't have the ammo to do it as a country. I would hope for a U-shaped recovery. I will even live with a U that is as large as a bathtub, but I don't see a V happen.
Right. But I think just to take the cue from there, what part of the U do you think we currently are? Like, are we on the way down, at the tapering towards the bottom, or on our way green shoots to go again, or where do you think we are?
So now you're asking me to time the market, which I never do.
But isn't that what you're supposed to do as a manager, anyways?
No, we never time the market. We're market neutral. But then anyway, so given, if you want, I'm going to give you my personal opinion and not that of the fund. I think where we are at least 3/4 of our way down. I don't think the bottom is too much lower. A lot of it has been priced in. I mean, if we were to just look at it in terms of back of the envelope math, the easiest way to do it is you had 2 months completely washed off. The companies that survived this crisis will actually have an unequal growth going forward, because a lot of it, their smaller competition would have in a way been washed away. There will be a greater amount of inequality. So if you're able to provide quality in this kind of a market, if you're one of those people who want to survive this crisis, expect very good times ahead. So that's where it would be. So yeah, let's hope I am wrong and it's far more proved wrong over here. I would really hope for the...
Right. No, thank you. So I think let me wrap up some of the discussions by saying that, okay, this is not business as usual. What was the theme we chose for the discussion today? It's definitely not business as usual, but we definitely see at least large parts of Mumbai, the financial industry, whether it's in Mumbai, Bangalore, or other places, everyone's working on email. I've been chased by a lot of people who are on the panel right now on the different things that they wanted us to help them with, whether it is their applications or fund documents and so on and so forth. So even though it may not be business as usual, but it is definitely operations as usual. We see a lot of the back offices being working as actively as they did. In fact, even more so now, with so much of less distractions out there. I think the productivity has definitely gone up, way up, such that there is some fatigue setting in with the amount of screen time that a lot of our clients are having, a lot of the back office operations are having. So much so that I actually heard somebody from a different team saying that they are planning to take a leave. Planning to take a leave in a COVID time is a massive statement. It does make quite a few comments by itself. So I think I leave it at that. So operations as usual, business unusual. With that, I think maybe if there are any closing comments from Praveen, you, Jinesh, or maybe Nishith bhai, if you're still on the call, if you have any comments to make. We have sort of covered the questions that were popping up from time to time. If you feel that we have not, maybe drop an email. You have my email ID, Nandini's email ID, all of us are there, and we can channel them through the panelists we had today. So with that, maybe Nishith bhai, you or Jinesh, Praveen, if you guys want to make some comments, otherwise we can then call it a wrap.
No, I think wonderful interaction and I think very useful insight. So all that I can say is thank you very much, Jinesh. I think Kalpesh, if you're still on the call, thank you very much for joining us. And Praveen, it was very good to hear your views. It's very helpful. And well, thank you for a wonderful discussion. So I think, I don't think I need to add too much, but everything has been discussed and it's been extremely useful. Thank you.
Great. So with that, I would like to thank the panelists for making time, and hopefully you're leaving these discussions with more insight and more understanding of what some of our GPs are grappling with, and you would have found some value in from these discussions.